Hello, everyone, and welcome to the fourth annual Financial Services Symposium Tax Update. My name is Dan Mayo. I'm a partner in the National Tax Group here at Withum. I lead the National Tax Group and spend a lot of time in the M&A space on qualified small business stock and work a lot in the financial services space, which is so well suited to lead this tax update today. We're going to start with we're going to cover a bunch of topics today, covering the OB3, the legislation that passed this July, qualified small business stock, self-employment tax, and a bunch of developments in case law, and it happened at the IRS. So we'll start today with qualified small business stock, which I know is an important topic for a lot of people, and talk about the three important changes that happened as a result of the One Big Beautiful Bill Act, or OB3 as I call it. So just as a refresh for everyone, qualified small business stock regime came in 1993. We call it either QSBS or Section 1202. And the purpose was to encourage investment in businesses that historically had difficulty attracting capital, so small businesses. The benefit for shareholders is that they get to exclude capital gain from gross income to the extent of the greater of 10 million or 10 times their original basis in the stock. So it's a pretty powerful provision of the code. It allows an exclusion up to 10 million or 10 times basis. That can be 500 million in extreme cases, or now 750 million under the OB3. However, you can imagine, along with the good things comes the bad, and the bad is the requirements here. It's not so bad, right? The requirements are just that it's an individual sells stock. The stock has to be qualified small business stock, which means it was stock obtained in an original issuance from the company. The stock must have been issued after that August 10th, 1993 date, and there are some staggered benefit periods. Approximately before roughly 2009, it was a 50% benefit. From 2009 to mid-2010, the 75% benefit. Then for stock issued after that, it's 100% benefit. So 100% of that 10 million or 10 times basis. The taxpayer has to hold the stock unhedged, typically not a problem. Usually we see non-publicly traded companies, so the availability of options is limited if someone wanted to hedge the stock. The company must be a C Corp, and then this other key requirement here is that the aggregate gross assets must be 50 million or less at issuance and immediately after the stock is issued. Some of the other things very quickly are the company must be engaged in a qualified trade or business, which generally is any trade or business except certain excluded trades or businesses. The issuer must be a U.S. company. It can't be a DISC or a RIC or REIT. RIC is a mutual fund. A REIT is a real estate investment trust, a REMIC. They don't usually see that come up very often. And then the company has to agree to provide certain information to the taxpayer and to the IRS. So what are the big changes from OB3? And this is really that QBS it was great before, and now it's even better. So the three changes, and all these changes apply only to stock that was issued or acquired by the shareholder on or after July 5th of 2025. So key date. So all stock issued prior to that is subject to those old rules, the rules I just mentioned, that the 10 million or 10 times basis is the benefit, and the 50 million aggregate gross asset limit. So what changed? Three changes, and then we'll talk about them in more detail. One is that the $10 million limit was increased to 15 million. Two, the 5-year holding period was expanded, so now they allow for 3, 4, and 5-year holding periods, although the benefit is somewhat reduced for the shorter holding periods. And then third is that aggregate gross asset threshold increased from 50 to 75 million. So let's dig into those three things and then talk more about it. So again, all of these things only apply to stock acquired on or after July 5th, 2025. So now for that stock, if you realize a benefit to the greater of $15 million or 10 times basis, and that 15 million will be adjusted for inflation starting in 2027. So it got even better. You can exclude a greater amount of gain. Planning tip we'll mention here is you want to sell your OB3 stock first. If you're not selling it all at once, you want to identify the pre-OB3 stock and sell that first, which has a 10 million exclusion, and then sell the OB3 stock later, which has that larger exclusion amount. Obviously, that wouldn't be till for another 3 years forward, right? 2.5 years, 3.5 years. 3-year holding period starting July 7th. So we're not going to start seeing this stock until 2028 at the earliest. July of 2028 is the earliest when someone's going to be selling OB3 stock and getting a benefit. The second change was the tiered holding period structure. So again, it only applies to stock on or after July 5th. If you hold the stock for 5 years, you get that 100% exclusion, same as before. But now they allow for 3 and 4 year holding periods. So if you hold the stock for 3 years, the exclusion percentage is 50%. If you hold it for 4 years, the exclusion percentage is 75%. Makes it a little better, right? Some people are forced to sell it earlier than the 5 year mark. It used to be you got no benefit unless you did a qualified rollover. Now you can get some benefit at the 3 and 4 year mark. The third requirement is this aggregate gross asset threshold increase from 50 to 75 million. This is great. I have to remember that that threshold applies at the time you receive your stock, so the company cannot have exceeded 75 million now, up until the point you received your stock, and then immediately after, which is unfortunately an undefined term. We like to tell people, think of it as 2 weeks to a month as a starting point, and it can be refined further if you need to. But so you can't exceed that 75 million the day you receive your stock, and then 2 weeks to a month after. Okay, so now we're going to switch focus and cover some of the other changes that maybe affect portfolio companies that you may be looking at as a result of the OB3. I know we only have 25 minutes today, so I'm going to run through a lot of these fairly quickly, and hopefully you can follow up if you need be, either by reaching out to me or by reaching out to someone your normal tax Withum contact, the person you normally speak to about tax at Withum, and we definitely can help you. So first big change from OB3 on the corporate side is bonus depreciation is back. So 100% bonus depreciation applies to qualified property acquired on or after July 19th of this year, as long as it's placed in service by the end of the year. So if it's acquired after that, before January 20th, so January 19th or earlier, you get 40% depreciation, which was it was phasing down from the past. So that 40% is what applies in 2025. So if you don't get the bonus or don't elect bonus, 100%, you're in that 40% rate for 2025. So when is property treated as acquired? Because there's two things, right? You have to acquire the property after January 19th, so January 20th or later, and you have to place it in service. Let's focus on that acquired date. Property is not treated as acquired after the date on which a binding written contract is entered into. So if you had a binding written contract to acquire property on January 1st, but you actually took delivery at January 31st, that wouldn't qualify for the bonus depreciation. And then I just want to highlight here, there's a regulation that pre-existed OB3, but it talks about the acquisition date of property and pursuant to a binding contract. So there is more detail if you have those unique situations where you're possibly straddling that effective date of January 19th. Self-constructed property has a different date, and so the acquisition date is the date that you manufacture, construct, or produce the property. And again, this is elective, right? Bonus, you can elect out of bonus depreciation and take that 40% or 60% for certain longer period property or aircraft. The next thing is this real property expensing for qualified production property. Totally new. This came in with OB3. It was not in the code before. Section new 168N. And this was enacted. It allows 100% bonus depreciation for non-residential real property manufacturing facilities. So this would have been subject to a 39% depreciation period. And now 100% bonus applies, subject to requirements, obviously. And this was enacted as a compromise because they didn't bring in, there was talk in the election about bringing in a 15% corporate tax rate for US-based manufacturing income. They did not enact that, so this came in instead. So the question is, what is qualified production? Qualified production is any activity, means manufacturing, producing, or refining, and then it only relates to agricultural production and chemical production. So there are some limits on this, but if you meet it, it's a wonderful new expense for the real property piece, the manufacturing facility on the real property. Of course, real property itself is not depreciable. There's a recapture provision because there are rules that require to use it for, I think, 10 years plus. If you break the rules, there's a recapture period, and it does come in at ordinary income, not the 25% rate under Section 1250. So just, if you're going to take advantage of this provision, you just want to make sure you plan out that you'll actually meet the requirements as they evolve over time and go forward. R&E expensing. So this is a great one, right? So research and experimental expenses since 2023 had to be capitalized over 5 years for domestic, 15 for foreign R&E. OB3 permanently reinstates that immediate deduction for domestic R&E expenses paid after 24, so in 25. Taxpayers can elect to slow that down if they want. So, what we recommend is people model out their R&E expensing to take into account Section 280C inclusions and possible R&D credits. So a lot of times it is a modeling exercise. The goal here generally is, why would you like to capitalize? If you don't want an NOL that's going to be subject to limitations that going forward, the percentage of, it can only offset a certain percentage of your income going forward. You would want to slow it down so you can use it every year, the full amount. Okay, so for businesses that elected, so what do you do for your prior capitalized amounts? All businesses can elect to deduct that previous amounts over a 1 or 2 year period starting in 25. You can deduct it all in 25 or half in 25, half in 26. Small businesses have an additional benefit. So if you meet that gross receipts test under 31,448,C, remember that's a 3 year rolling average of gross receipts. It has to be under 31 million. If it is, you can expense your domestic R&E expenses. You can and then file amended returns for 22, 23, and 24 to go back and retain a refund. So reminder, it only applies to foreign R&E, not to, only to domestic research and experimental expenses and not to foreign R&E. Next thing is the interest expense limitation 163J. Recall that the Tax Cuts and Jobs Act of 2017 allowed for, imposed a limitation of 30% of adjusted taxable income. In the beginning, that included EBITDA, which is a larger number, then it was reduced to EBIT. It was lowered a couple of years after it came in. OB3 brings it back to EBITDA, so you can add back the depreciation and amortization. So it's a larger base upon which to calculate that 30% limitation. But it does include a new ordering rule that limits the application of 163J. It has to be done before interest capitalization provisions. So what people were doing is they would capitalize a lot of interest expense to inventory, for example, to help avoid the 163J limitation, the 30% limitation. Now you're required to do that first for most interest, 163J calc first limitation before the most capitalization provisions, though not all of them. And so this is this permanent extension kicks in this year, 2025. Other provisions, and we're going to tick these off somewhat quickly because I know we have very limited time here to cover a lot of material, and I do want to cover a lot of stuff to give you a good update for the year. So it permanently extends that qualified business income deduction, that 199A deduction, keeping it at the 20% tax rate. For 179 property that gets expensed, they increased the limitation. It went from 1.25 million to 2.5 million in 2025. And it doesn't phase out until you exceed 4 million of 179 property. So that's a nice increase from prior years, nice and favorable provision. For employee retention credit claims, OB3 extended the statute of limitations to the later of the deemed filing date or the actual filing date, only for Q3 and Q4 2021 claims. So 2021 claims still have a 3-year statute, and 2020 claims have a 3-year statute, and 2021 claims for Q1 and Q2 also have a 3-year statute. So the way that works is for Q1 and Q2 of 21, those returns are deemed filed April 15th of 22, which means the statute of limitations expired in April 15th of 2025. So the statute of limitations on assessment for those claims is over. Q3 and Q4 remain open for a few more years because of this extension under the OB3. OB3 also cut off Q3 and Q4 claims that were filed after January 31st of 2024 and that will remain unpaid as of July 4th, which is the date OB3 was passed. If you recall, this is a provision that initially surfaced in mid-January of 2024, but never passed at that time, and the IRS has been pushing for it ever since. It was a revenue raiser, so they brought it back now and cut off claims that were unpaid and filed unpaid as of the OB3 passage date and filed after January 31st, 2024, only to the extent they relate to Q3 and Q4 21. Next thing is a new floor on corporate charitable deductions of 1% based on taxable income. So amounts below the floor are permanently lost, but if you would contribute a larger amount and exceed the 10% cap on charitable deductions, that amount excess can be carried over. So what we're recommending to clients is consider bunching deductions, charitable deductions this year, next year, 2027, as many years as you want into 2025. You won't be subject to that limitation. bunching is generally a good strategy. Even if you're going to bunch next year, you should do it. But if you can bunch in 25, even better than 26. On the individual side, OB3 did a lot of things, including permanently extending that 37% max rate. Remember, it was scheduled to snap back to 39.6. It did not. So that rate will stay. It also kept that increased standard deduction, right? It will be adjusted for inflation. So for this year, it's $31,500 for married filing jointly, and next year it'll be $32,200. On the negative side, it did permanently eliminate miscellaneous itemized deductions, right? There was a temporary elimination, now that's permanent. So obviously a big issue for the fund space. That won't be coming back. Same thing with personal exemptions. It also, another negative thing is itemized deductions. If you do itemize, it caps the benefit of those deductions at 35%. So if a taxpayer is in the 37% bracket, they're only going to get a 35% benefit on those deductions. So it takes away the overall benefit of itemized deductions. On the positive side, the SALT deduction limitation, state and local tax deduction, has increased from $10,000 to $40,000 a year for married couples. That will be indexed for inflation, but it's only for a couple of years. It's only 2025 through 2029, and it does revert back to $10,000 in 2030. So it is a temporary measure, and also subject to phase out. It starts phasing out when the taxpayer's modified adjusted gross income exceeds $500,000. If it exceeds $600,000, you're totally phased out. And I put the calculation here. I won't go through it now, but it essentially the amount over takes 30% of the amount over 500,000, and that's how you reduce the 40,000. But you can't go below 10. So everyone gets 10 regardless of income. But when you exceed 600,000 is when you're totally phased out. You're back to 10,000. Pass-through entity taxes, or PTETs, remain unaffected. So there are 36 states and New York City that have PTETs. Some states call it different things, like New Jersey's debate, calls it debate tax. So if you're engaging in state tax planning where you're paying that at the entity level and get a federal benefit, you can still bypass the state and local tax deduction by using a PTET. OB3 also permanently extends that excess business loss limitation, right? The 461L limitation. While that's a negative, right? You're limiting your losses. I think it's 600 and something thousand for married couples. The carryover, there was talk of extending when the losses carry over, they were going to subject them again to 461L in later years. They didn't do that. So you apply that 461L limitation once in the year you have the loss, and then you don't have to reapply it again. It becomes an NOL in later years, subject to the NOL limitations, but you're not required to retest under the EBL, excess business loss limitations. The lifetime estate and gift tax exemption is going up to 15 million next year, indexed for inflation, 15 million per person, so 30 million per married couple. That's a nice change. That was scheduled to snap back to somewhere around 7 million. That won't be snapping back though. Charitable deductions, if you don't itemize your deduction, you take the standard deduction, taxpayers are allowed to deduct up to $2,000 of charitable deductions. It's $1,000 for married filing single. And there's a floor, much like that 1% floor for the corporate deductions. There's a 0.5% floor for individuals. And again, the amounts below the floor are permanently lost, cannot be deducted. But if you do exceed the 60% cap for individuals, that excess can be carried forward. We have some new deductions that came in for tips, overtime, car loan interest, and seniors. I won't spend too much time on them. They're all temporary from 2025 to 2028. Different amounts. The IRS has come out with some proposed regs on the tips, on the overtime, and car loan interest. And we'll talk a little bit about employer reporting. Employers are not required to report tips and overtime, although they're encouraged to do so. But the lenders are required to report car loan interest this year in 2025. The deduction for seniors came in. There was talk about making Social Security not taxable. They couldn't do it because the OB3 was passed under the reconciliation provisions. Instead, in lieu of that, they came out this deduction for seniors. If you're 65 or older, you take a $6,000 deduction per individual, $12,000 for a married couple. They are phase outs though at $150,000 for married filing jointly. Another great provision similar to qualified small business stock, although slightly less generous, and only because of longer holding periods. The opportunity zone. So Oz 2.0 is what people are calling it. The OB3 brought in a new opportunity zone program starting in 2027. very favorable benefits. If you realize capital gain and invest within 6 months into a QOF, a qualified opportunity fund, and you hold it for 5 years, you can increase your basis 10%, eliminate some of that gain. And then if you hold it for 10 years, you get to eliminate all the gain on the QOF investment. That basis increase you see on that middle slide here goes to 30% for qualified rural opportunity funds. That's new. Nice increase. They're generally smaller designated zones for smaller communities, and very favorable if you can get into one of those zones. Okay, so we'll talk about self-employment tax. We're going to get into really speed tax now because we have very limited time. So I'll tick on a lot of these issues. Please do reach out, though, if you want to discuss anything at greater length. Self-employment tax for limited partners. This issue has been around for a while. The IRS is of the view that not all limited partners are exempt from employment tax. Only the piece that's a distributive share is a return on investment, not the piece that's a compensation for services. Sarabon was a big case decided in 2023 that settled the issue somewhat at the tax court, but then didn't decide that it was a summary judgment motion, didn't decide the facts of the case. May of this year, the tax court came out with a memorandum opinion, which is not precedential, by the way. It's just applying the existing law to the facts of the case. And they said that the 3 owners of Sarabon Capital were subject to the self-employment tax because they worked for over 2,000 hours a year and were integral to the success of the business. So they were really more like guaranteed payments, not a distributive shares or return on investment. There's a functional analysis test that is required to be done. I will mention that a couple of these cases are on appeal. I think Denham Capital Management is expected to go first. So we may get more guidance this year from the appellate courts on what the rule is for self-employment tax as it applies to limited partners. Okay, so ABV is a merger termination fees. In general, the taxpayer deducted as an ordinary deduction. The IRS said it was a capital loss. The tax court came out in favor of the taxpayer and said you can take an ordinary deduction for a breakup fee. So nice favorable decision for the taxpayer. Basket contracts. So this is a case where a taxpayer was managing a basket of stocks. They wrapped it up into a call option to take the position that they got capital gain when they settled the option, long-term capital gain, as opposed to short-term capital gain when they traded the individual securities that underlie the option. The next case was in April of this year, GWA LLC. This is a case where a taxpayer was trying to seek deferral and conversion by taking a managed account of individual stocks, wrapping it up into a call option, and took the position that these 12-year call options, when they settled the call options, they had long-term capital gain as opposed to short-term trading gain over the course of the 12 years. The IRS ruled against this in 2010. You see here I cited an article that I wrote back in 2011 on the topic, and the tax court came out against it as well. And so they listed a bunch of factors. In the interest of time, I won't go through it, but interesting case if you want to see a case where a taxpayer used a wrapper to try and defer and convert short-term capital gain into long-term capital gain. Other guidance, the IRS came out with 83B, Form 83B, an election for 83B elections last year. This year they allow electronic filing, so that's helpful for a lot of partners who receive profits interest who make a protective 83B election, also for shareholders who receive restricted stock grants, can now be filed electronically. Borrow fees, the IRS in October came out with a notice announcing their intent to source borrow fees by the reference of the residence of the taxpayer. So residents, the recipient, much like forward contracts and NPCs. Recall borrow fees come up in a stock lending transaction where one party lends stock to another and the person receiving the stock pays a borrow fee to the lender. So there was more guidance will come on that in the near future. Crypto guidance, the IRS came out with a revenue procedure a couple weeks ago on November 10th, providing a safe harbor for grantor trust structures. So if the grantor trust is staking cryptocurrency, it will not be considered a power to vary, which would destroy grantor trust status. A bunch of requirements are in the revenue procedure, but if you meet them, a helpful provision to allow for the staking activity to occur without triggering or without destroying